Our classroom stock portfolio now has an annual return of 19.57%. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,118.93 after 129 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks. So that's about $1.25 per stock. And since my accounting students can't stop talking about artificial intelligence stocks, this week, just for fun, we created a 10-stock portfolio of our favorite AI stocks and how we would allocate to each stock. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting almost 2.5 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week or the list of our best performers or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then, in 2023, stocks took off. Currently, the portfolio's value, as I mentioned, is over $2,118, and the return has been 19.57%. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and in the preceding year, the portfolio once again beat the market. Now this week, my students and I dove deep into a research paper by the Center for Financial Research that covered all things artificial intelligence stocks. We constructed a portfolio of our favorite AI stocks, and it just happened to be an even 10 stocks. The largest grouping comes from software, which includes Microsoft, CrowdStrike, which is a cybersecurity firm, ServiceNow, Adobe, and Google. The next largest come from the chip industry, with those being NVIDIA, Broadcom, and Marvell. And since AI will increase the need for storage and memory, we included Pure Storage and Micron, respectively. It'll be fun to monitor this portfolio's performance. Just note that many of these are high-risk stocks, and their valuations tend to be very high. This portfolio is not for value investors, it's for growth investors. Most of these stocks do not pay a dividend, but as I mentioned later in the video, Broadcom has increased its dividend astronomically in a short time period, providing a great yield for those who bought it during the pandemic when the media was all doom and gloom. Now back to our regularly scheduled program. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison for when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 24.4%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 21.4% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, but time will tell. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to Hartford's study, over the last 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of the screen. Maybe, more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom dividend stock portfolios only invest in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I had invested in the stock, I would receive $5.01. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 8.13%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend well in the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields on cost that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. And if you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate in income from qualified dividends that would be federally tax-free. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I do for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. For our classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. And in year 3, inflation wasn't quite as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. Now, SCHD is a large holding in my personal account, so I've been tracking SCHD performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is over $2,118. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be $1,822, a difference of 16.3%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio stocks. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in the stocks that I consider to be value traps. Now this slide shows our best performing stocks based on when they were initially purchased. Broadcom is still at the top with a total return of 197.5% in about 2 years. Broadcom is a chip maker and recently announced it will split its stock 10-for-1. Moving up the chart the most this week is Intuit, the maker of TurboTax and QuickBooks. Remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% of our investments made in this portfolio were made to these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. They're usually very large companies, like Microsoft. The other 10% of the investments so far have been made in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they tend to be smaller companies, but studies have shown that they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week. This week, our large tech stocks took a breather for the most part. Instead, many of the non-tech and smaller stocks led the way. The 5 stocks on the left of the chart are under-the-radar dividend payers that recently initiated a dividend. Salesforce is the only large company of those 5, with Bolero, ClearSecure, Fidelis, and Worthington Steel being much smaller. The biggest gainer this week was Gilead Sciences with an 8.6% gain. Before we look at the 10 stocks we bought this week, here are the 10 dividend growth stocks we bought a year ago, along with their total returns, which of course includes dividends. Domino's Pizza is the best performer of the stocks that we bought that week, so far providing a total return of 60.8%. We still own all the stocks except the stocks in yellow. Most of these stocks were purchased over multiple weeks, which is why many have appeared in recent videos, but this slide only refers to the investment made a year ago. The average return of the 10 stocks we bought a year ago is 31.59%, despite 3 stocks not being held the full year. The annualized return for all 10 stocks is 34.4%. Obviously, our purchases won't continue that high rate of return, but so far it's a great start. And before we got to the stocks that we bought this week, here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. And we don't often sell stocks, and this week was no exception as we made no sales. Now let's get to our purchases. Here are the dividend growth stocks we bought this week. Here are our ratings for the top 10 dividend-paying stocks according to our system, and they are Comcast, Visa, American Express, MasterCard, Allegiant, Northrop Grumman, Masco, FactSet, Interpublic, and Huntington Ingalls. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on the brokerage company's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be Comcast, Allegiant, Northrop Grumman, FactSet, and Interpublic. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields are, in order, Interpublic and Comcast. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. As mentioned before, the other 10% of our purchases have been in the usually smaller under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller, but studies have shown they historically beat the market averages by a significant amount. But all 10 of our stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And earnings is just another fancy way to say profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at American Express, FactSet, and Huntington Ingalls. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings this week are Visa, MasterCard, and FactSet. Now let's look at the dividend growth rates or dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and higher yield are Comcast, Visa, Allegiant, Northrop Grumman, and Interpublic. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's usually not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Visa, American Express, and MasterCard. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, Visa, American Express, and MasterCard. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of each individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once a stock split has occurred. As you can see, Broadcom is the most recent one to announce a stock split, and all of our 3 have decided to split 10 for 1. Here's a look at the 10 stocks that make up the largest portion of our dividend growth portfolio. Microsoft is still on top. American Express made the biggest move from 6th to 3rd. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of the portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are at 95. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies make it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and does not take that much time. Now, I've had several older students who are closer to retirement take my classes, and they are more interested in stocks with higher dividend yields and have asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of last year, we started investing $12.50 each week into stocks with higher dividend payouts. Currently, the portfolio's dividend yield is 4.5%, but the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. The portfolio as a whole has an annualized return of 24.4%. Since the portfolio has been in existence for less than a year, that return will likely fluctuate a lot. Now, 2 strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth and has been the better performer so far. The average investment in this strategy has provided a total return of 11.75% and has been held for an average of 149 days so far, which is an annualized rate of 31.3% using Excel's rate function. Now, it's not likely that the stock portfolio could keep up an annualized return that high, since stocks historically average somewhere between 9 and 10%. On the next slide, we'll look at the high yield dividend-paying stocks we bought this week. Now, as I mentioned, one thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close to retirement. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is equivalent of 1/4, which of course is equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing strategy 1 are Devon Energy, Chevron, Interpublic, and Gilead. And the 4 high yield stocks we bought this week while implementing strategy 2 are Interpublic, Chevron, Evergy, and Papa John's. This week's purchases have an average yield of 4.6%, with Devon Energy coming at the highest with a 6.1% dividend yield. Here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So in the comments, let me know if you have any questions or if you want to know more about any of the other portfolios we discussed before. Also, let me know what other kind of investing videos you'd like to see. Finally, here are the places you can reach me: YouTube, obviously, as well as X and LinkedIn, and my website, beatthestockmarket.com. We'll see you next week.